Dear students, I am Dr. N.K. Agrawal, former Joint Director of Studies, the Institute of Chartered Accountants of India, and Director Gibbs. I shall facilitate your learning of financial management through video lectures to enable you to study the subject at the time and place of your choice and convenience and suitability. If at any point of time during these video lectures you feel any difficulty or come across any problem, you are most welcome to interact with me through email without any hesitation. You can discuss your problems and difficulties face to face also with prior appointment. Now, today I shall discuss scope and objectives of financial management. First of all, let us understand the meaning of financial management. Financial management is concerned with the issues relating to investment, financing, and monitoring financial performance of an organization. It deals with procurement of funds and their effective utilization in the business. In fact, the efficient management of every business is closely linked with efficient management of its finances. Sound financial management is a key to success and progress of any business enterprise. The financial management is analytical in nature. Various decisions in financial management are arrived at after detailed analysis of the available data. Though quantitative in nature, serious thinking and foresight are used in financial decision making. Financial management is affected by financial and economic environment of the country. Up to a few decades ago, financial management was not a separate field of study. For all practical purposes, it was part of accounting. It emerged as a distinct field of study at the turn of the 20th century. Today, financial management and financial accounting differ in the treatment of funds and also with regard to decision making. As regards the treatment of funds in financial accounting, the measurement of funds is based on the accrual accounting principle, whereas in financial management, funds are considered on the basis of actual cash flows. In fact, the accrual-based accounting data do not reflect true financial conditions of a firm. An organization which has earned profit on the basis of accrual accounting principle, in the accounting sense, it may be said that the firm is profitable, but it may not be able to meet its currently maturing obligations on time due to shortage of liquidity. The movement of actual cash flows help financial managers to avoid insolvency and achieve desired financial goals. Similarly, in the areas of decision making, the main focus of an accountant is to collect and prepare data and present the same to the management for decision making purposes. Whereas, on the basis of financial data presented by an accountant, the financial manager uses the same for financial planning, controlling, and decision making, which are his primary responsibilities. Thus, it may be said that financial accounting ends and financial management starts. Now, let me tell you about the scope of financial management. The scope of financial management is very wide. It covers all types of organizations, whether an organization is profit organization or not for profit organization, private organization or government organization, large organization or small organization, manufacturing organization or trade organization. Financial management is also essential in centrally planned economy as well as in a capitalist setup. In modern age, the scope of the function of finance manager virtually has no limits. His role is constantly changing and expanding. Now let us see what is the importance of financial management. Financial management is very important in any organization. The ultimate success of an organization depends on an efficient management of its financial position. It includes raising of funds wisely and using them properly and efficiently. Financial management is an essential ingredient in any organization. In a resource constant economy or organization, its importance is especially highlighted. Now let us see what are the objectives of financial management. Financial management has two objectives. Number one, profit maximization, and number two, wealth or value maximization. I briefly explain each of these objectives. First, we take up profit maximization. Profit maximization is traditionally the objective of financial management. In fact, traditionally, the objective of any business organization is to earn and maximize profits. As such, the objective of financial management is also profit maximization. But profit maximization objective has certain limitations. These limitations are: number one, profit maximization objective is that the term profit is vague. It is not clear whether it is short-term profit or profit in the long run, or it refers to total profit or only the rate of profit. The next limitation of profit maximization objective is that the term profit is exposed to high risk. To maximize profit, a firm may assume disproportionate risk, which may in future prove very harmful to the organization. Another limitation of profit maximization objective is that this objective is too narrow. It does not take into account social considerations and obligations to workers, consumers, and ethical trade practices. Another limitation of profit maximization objective is that many times a firm may not undertake planned maintenance of plant and equipment simply to maximize profits in the short run. Another limitation of this objective is that the term profit does not indicate the time pattern of returns. Another limitation of profit maximization objective is that it confuses earnings with cash flows. It may be noted that earnings shown by profit and loss account are not in the form of cash available to shareholders. Profit figure is on accrual basis, whereas actual cash may be different. That's why this is taken as a limitation of the profit maximization objective. Now let us see the second objective, that is wealth or value maximization. In view of the limitations of the objective of profit maximization, it is commonly agreed that true objective or goal of business should be to maximize its wealth or value and not profits only. Hence, the wealth or value of a firm is represented by the market price of company's equity shares. Normally, the market value of a share is a function of two factors. Number one, likely EPS, that is earnings per share, and number two, the capitalization rate or required rate of return of shareholders. Hence, at any point of time, value of the share is equal to EPS divided by capitalization rate. For example, if the expected EPS is rupees 6 and the capitalization rate or required rate of return by the shareholder is 15%, then the value of the share will be rupees 40. This is arrived at rupees 6 divided by 15%. Generally, a conflict arises between profit maximization and wealth maximization objective. Some people consider profit maximization as a better objective than wealth maximization. However, in view of the limitations of profit maximization objective just enumerated, it has been agreed by majority of financial experts that wealth maximization should be the true objective of financial management. Now let us see what are the basic tenets or principles of financial management. The basic tenets or principles of financial management involve the way funds are procured and how they are utilized. According to the principle of financial management, the procurement of funds should be at minimum cost and their utilization should be in such a way that they yield maximum return. At the same time, striking a balance between risk and return. We will see later on that how risk and return are taken into account in an organization. Now let us see what are the tasks of financial management. The important tasks of financial management are: number 1, investment decision; number 2, financing decision; and number 3, dividend decision. In addition, the task of financial management also includes financial analysis, planning, and control. The investment decision involves capital budgeting, that is, identification, selection, and implementation of capital projects, including leasing and management of current assets, that is, working capital management. Working capital management includes cash, marketable securities management, receivables and payables management, and inventory management. Investment decisions also include management of mergers, reorganizations, and disinvestments. In financial decision making, the task of financial management involves identification of sources of finance, including the study of capital markets and determination of financing mix, cost of capital, capital structure, and valuation of the firm. It also includes raising funds, including lease financing and division of profit between dividends and retained earnings, that is, dividend decisions. This includes determination of dividend policy or internal fund generation for reinvestment in the business. Dividend decisions relate to decision making with regard to distribution of the proportion of profit earned by the company, their distribution to the shareholders. The dividend payout ratio indicates what portion of earning is paid to shareholders and what portion of the earnings is to be retained in the business. The dividend decision also results in the maximization of shareholders' wealth. Broadly speaking, dividend decision is analyzed in relation to the financial decision making of the firm, as I stated earlier. To carry out the above decisions effectively and efficiently, the firm has to undertake financial analysis, planning, and control, which include: number 1, analysis for decision making and performance evaluation; profit planning, that is break-even analysis and interpretation of financial data representing operative activities; financial forecasting, which means estimating requirements of funds, short term and long term, and their timings; and last but not the least, financial control is exercised by means of budgetary control and long-range planning. Now let us see what are the functions of Chief Finance Officer. Based on the functions of financial management, all the functions of Chief Finance Officer are divided into two categories: main functions and subsidiary functions. I briefly enumerate here these functions that they will be dealt with in detail in appropriate future lectures. Main functions are: number 1, estimating the requirements of funds for fixed assets and current assets based on forecasted physical activities of an organization. Number 2 main function is decision regarding capital structure, which includes borrowed funds and owners' funds. Number 3 main function is investment decision, which include capital budgeting and working capital decisions. And 4th main function is dividend decision. However, it may be noted that all these functions are interrelated and decisions are also interrelated. Now let us see what are the subsidiary functions. In subsidiary functions we include: number 1, supply of funds to all segments of the organization, or in other words we can say cash management. Number 2 subsidiary function is evaluating financial performance or financial statement analysis. Number 3 subsidiary function is financial negotiations with banks and financial institutions for raising funds. And 4 subsidiary function is keeping touch with stock exchange quotations and behavior of share prices, a constant watch on the movement of share prices at the stock exchange. Now please see this organization chart. This gives you an eye view of the finance function in the total organization. This chart shows you that at the top we have board of directors. Below board of directors is president. President is having BP production, that is vice president production, vice president finance, vice president marketing, vice president human resource development or HRD, and vice president IT. This now has become, IT has become very important area nowadays in any organization. Now finance function is divided into two categories. One is headed by the treasurer, another is headed by the controller. Under treasurer you are having credit management, cash management, banking relations, and portfolio management. Under controller you are having general accounting and cost accounting, then taxation problem, then internal audit and budgeting. The Chief Finance Officer or Vice President Finance directly reports to the President of the organization. Below him are Treasurer and Controller. As I just said, Treasurer's areas of responsibility include credit management, cash management, banking relations and portfolio management. Whereas controller is responsible for general accounting, cost accounting, taxation aspect, internal audit, and budgeting. He also analyzes information for managerial decision making, that is, for taking decisions with regard to capital budgeting, capital structure, dividend payment, planning, and control. You may please note that these designations are only illustrative. Titles or designations may vary from organizations to organizations. So we should have some idea that how an organization chart of finance function is prepared, or how what we perceive from the placement of finance function in the total organization. Now, generally, a question arises whether there is a relationship of financial management with other areas of management. Financial management has close relationship with other areas of management such as production, marketing, human resource development, and information technology or IT. Financial management also has very close relationship with economics and accounting. As I told you in the beginning, in fact, earlier accounting, with the passage of time, a distinct discipline of financial management has developed. A basic knowledge of economics helps the finance manager for correct financial decision making. The accounting function generally falls under the domain of Chief Finance Officer, now popularly known CFO, as shown in the organization chart of finance function. However, financial accounting and financial management are complementary in nature. Now let us briefly view the methods or techniques of financial management. The financial manager or finance manager uses various methods and techniques in the discharge of his functions. These techniques are projected financial statements by using the technique of budgetary control and long-range planning for estimating funds requirement. The method of financial leverage or trading on equity in the context of financing and capital structure decisions. Accounting rate of return, that is ARR, payback period, internal rate of return, that is IRR, then net present value, that is NPV, profitability index, that is PI, are the methods or techniques used for evaluating investment decisions. Working capital forecast statement, cash flow and fund flow analysis, cash budget, centralized versus decentralized cash management, working capital management, or managing liquid resources of firm. Various models are used nowadays for deciding dividend policy. Important models are Walter's model and MM theory. Financial ratios, ROI analysis, DuPont chart, these are used for performance evaluation. So, various techniques are used for the discharge of various functions by finance manager. All these in detail will be studied in the future lectures at appropriate time. Now, I would briefly refer financial planning. Financial planning is an important aspect of firm's operations and livelihood. It provides a roadmap for guiding, coordinating, and controlling the firm's actions to achieve its objectives. Two key aspects of financial planning are cash planning and profit planning. Together, these are known as financial plans. These plans guide the actions of the company for achievement of immediate and long-term goals. Lenders frequently require submission of these plans. Financial planning requires a good deal of business experience. How the company will be affected by external and internal forces. Finance cannot be viewed as an isolated area. All inputs should have the validity for evaluation. Financial planning is influenced by external and internal factors also. In external factors, general economic situation, inflation in the economy or inflation rates, current and expected interest rates, tax laws, and cost increases, all these are considered in internal factors. In external factors. Internal factors are generally company specific, so they may vary from company to company. Now, let us have some brief idea about the concept of risk, return, and uncertainty. Risk refers to the variability of earnings. In other words, chance of loss due to variability in earnings, etc., refers to risk. In financial management, risk can be measured by computing standard deviation or beta coefficient. The return has direct relationship with the risk. Basic principle is higher the risk, higher the return. From the viewpoint of investors, investment in equity shares is considered riskier as compared to investment in debentures or bank fixed deposits. The basic financial decision relating to investment and financing involve risk-return trade-off. A finance manager has to strike a balance between risk and return. Risk can be classified into systematic risk and unsystematic risk. Risk which cannot be diversified is known as systematic risk or market risk, whereas risk which can be diversified is called unsystematic risk or specific risk. Uncertainty refers to a situation which is not certain. It also relates to the risk and its measurement. Situation of uncertainty prevails when risk cannot be calculated exactly or when objective calculation of risk is impossible or difficult to make. This may be possible due to lack of relevant information or impossibility of exact measurement. For example, for an insurance company, it may not be possible to calculate the premiums for ensuring profits or loss of a speculative business. Now, dear students, this was an overview of financial management. In future lectures, I shall cover specific topics on financial management. So I conclude here the first lecture. Thank you very much.